Alright, so starting with 2021 A-level accounting part 2. Okay. So the first question, company account. Starting off with the additional information. Before preparing the financial statement for the year ending 31st March 2021, adjustments have to be made for the following. So there are around 10 adjustments. We have to make the statement of profit or loss and other comprehensive income, statement of financial position, statement of changes in equity, then we'll have notes and working to do. Starting off with the first one, office equipment costing 1,200,000 was purchased on 30th of June 2020. Was purchased on 30th of June 2020, and it has been properly accounted. This is the only purchase as to property, plant, and equipment during the year. Okay. So then we have PPE. They have given the closing balances. Okay. So they are saying office equipment costing 1,200,000 were purchased and it has been properly accounted. So then what will be the opening balance? The office equipment given here is 7,500,000. The purchase is 1,200,000. That means the opening balance will be 7,500,000 minus 1,200,000. That is 6,300,000. So go to the PPE note under office equipment opening balance 6,300,000. Once again, how did I find it? Here they are saying this purchase of office equipment was recorded. So they have recorded a cost of 7,500. If you remove that purchase of 1,200,000, you can get 6,300 as the opening balance. Now we purchase 1,200,000 worth of office equipment, right? You can add it under addition. So you can say the acquisition. All right. Then next, the land and office equipment were revalued for the first time and their market prices on 31st March 2021 as follows. Okay. So the land was revalued to 15,000. The land balance given here is 10,000. So this is the amount before revaluation, right? So you can consider that as the land opening balance, 10,000. Now the land was revalued to 15,000. Land doesn't have any depreciation. Therefore, the revaluation surplus from land will be 5 million. 5 million. Now that land revaluation surplus you can record under other comprehensive income. Revaluation surplus, land. All right. So then next, office equipment. Okay. Uh, the land and office equipment were revalued for the first time on 31st March 2021. Office equipment 5,000. Okay. Office equipment is revalued to 5,000. So you can write the closing balance as 5,000. So then what we can do, we have to remove the depreciation, right? They are revaluing at the end of the year, and here they are saying at the third adjustment, the depreciation for building and office equipment for the current year has been correctly calculated and accounted. So they have correctly calculated depreciation for the building and office equipment. So this will be the correct closing balances. 3,000 and 1,500. Okay, 3,000 and 1,500. So building 3,500. Sorry, building 3,000. Now office equipment, the entire depreciation we have to remove during the year because we are revaluing it. So when you are revaluing, you have to remove depreciation, right? Accumulated depreciation debit, relevant asset account credit. So the closing depreciation of office equipment is 1005. You have to remove that here and you have to remove it from office equipment as well. Okay. Then now we can find the opening accumulated depreciation this way. Depreciation of building 900, depreciation of office equipment 750. So during the year 900 and 750. Then what will be the opening balances of depreciation? 3000 minus 900, that will be 2100. 1500 minus 750, that will be 750. So now we have to find the revaluation deficit or gain. How do we find that? So I can do a working here. Revaluation gain or deficit equals to revalued amount minus carrying value. The revalued amount of office equipment is 5 million. The carrying amount of it is, so here we have the the total cost is 7,500. 6,300 opening balance. We purchased the new office equipment worth 1,200,000. Totally the cost is 7,500,000. Minus the accumulated depreciation is 1,500. So 5,000 minus the carrying value will be 6,000. There is a deficit of 1,000. Now this is also being revalued for the first time, right? Revalued for the first time. 7,500. So yeah, the deficit is 1 million. You can record that deficit here. Now it's revalued for the first time, right? So you can record it under other expense. So first we put the opening balances of expenses. The balances given in the trial balance are here 7,200, 6,800, 600 and 1,200. 7,200, 6,800, 600, 1,200. Okay. The next one, a motor vehicle. Okay, sorry. I no, I was supposed to put the deficit. Now it's a first time revaluation deficit that will go to other expense. Office equipment deficit. How much is that? 1,000. 1,000. Okay. Then next, a motor vehicle was sold on 1st of October 2020 for 4 million. Okay. This motor vehicle has been purchased on 1st of October 2018 for 5 million. And the company depreciates motor vehicle annually at 20% on cost using straight line method. The cash received by selling the motor vehicle has been debited to cash account and credited to motor vehicle account. Now the entire amount received as cash from selling the motor vehicle has been credited to motor vehicle account. We don't credit the received amount, right? We remove the cost of it. So now Here they have removed the selling price of it from the motor vehicle. Then what will be the opening balance? 18,000 plus 5,000. They have deducted this 5,000, right? If you add that 5,000, you can get the correct opening balance. Eight. So how much is that? Motor vehicle 20,000 plus 5,000. That's gonna be 25,000. Motor vehicles 25,000. Okay. The cash received, okay. No other entry have been made in this respect. The depreciation on motor vehicles for the current year has been calculated and accounted for the whole year based on the opening balance of motor vehicle. Now, motor vehicle, you are disposing in the middle of the year, right? Now, because you're disposing in the middle of the year, for this motor vehicle worth sorry, wait. So here they have credited the selling price of the motor vehicle from the motor vehicle account. The selling price is 4,000, not 5,000, right? The motor vehicle was sold for 4 million and that was credited to the motor vehicle account. Then you're supposed to add 4 million. 20 million plus 4 million, it's gonna be 24 million. 24 million. Sorry about that. So then no other entry has been made. Okay, now here they have calculated depreciation for this motor vehicle for the full year. We are not supposed to calculate for the full year. We are supposed to calculate on until this date, first of when is it? On 1st of October 2020. Okay, I'll show how to do that step by step. Now here motor vehicle depreciation. Motor vehicle depreciation is given as 6,500,000. The depreciation for the year for motor vehicle is given as 4,800. Then the opening balance would be 6,500 minus 4,800. 6,500 minus 4,800, that is 1,700. 1,700. Okay, now let's calculate the correct depreciation for that. Motor vehicle. We have motor vehicle worth 24,000 as at the opening date. Out of that, a motor vehicle worth 5 million we are disposing. So under disposals, you can say 5 million. And we will have a remaining motor vehicle of 19 million. Now, motor vehicle are depreciated at 20% on cost. So this 19 million worth motor vehicle will be there for the entire year. So into 20 over 100, that will be 3,800. Therefore, 5,000 into 20 over 100 into we are disposing it. We are disposing that motor vehicle on 1st of October 2020. So that motor vehicle was there from now our year is starting on 1st of April 2020. So 1st of April 2020 to 1st of October 2020, that is uh, April, May, June, July, August, September. Yeah, that will be 6 months. So you have to calculate depreciation for 6 months for this motor vehicle that you are disposing. 5,000 into 2 divided by 100 into 6 divided by 12, that will be 50. 50, yeah. Okay. 5,000 into 0.2. No, it will be 500. Then the total depreciation for the year for motor vehicle 3,800 plus 500, that will be 4,300,000. This will be the correct depreciation for motor vehicle. So for motor vehicle, you are going to put depreciation for the 4,300,000. Now, how much is the depreciation they have recorded? They have recorded 4,800,000. So they have overcasted the depreciation by 500,000. It should actually be 4,300. Now they have recorded the depreciation as 4,800 under distribution cost, right? We'll remove that extra amount they have recorded. So you can say under distribution expense minus 500 motor depreciation. Okay. Now we are supposed to remove the full amount of depreciation, accumulated depreciation for that disposed asset. So disposed asset, the cost is 5 million. The cost of the disposed asset is 5 million. When I do the work, I do it here. Okay. The cost of the disposed asset is 5 million. You purchased it on 1st of October 2018. The depreciation rate is 20%. So multiplied by 20 divided by 100 into, to find accumulated depreciation of the disposed asset. You're purchasing it on 1st of October 2018. You're disposing on 1st of October 2020. 18 to 19, 20, that is 2 years. So you have to calculate the depreciation for 2 years to find the accumulated depreciation of the disposed asset until the disposal date. 5,000 into 20% multiplied by 2. The accumulated depreciation of the disposed asset is 2,000. So you are supposed to remove that accumulated depreciation from the accumulated under removal of depreciation 2,000. So remember, when you're disposing an asset, you're supposed to remove the accumulated depreciation relevant to that only from the accumulated depreciation. But when you're revaluing, you have to remove depreciation both from cost and accumulated depreciation. Okay, so now let's find the disposal gain or loss. Disposal gain or loss. Disposal gain or loss equals to selling price of the asset minus carrying value. They are selling that motor vehicle for 4 million, right? The motor vehicle was sold for 4 million. So 4 million minus carrying value. The cost of the disposed asset is 5 million. The accumulated depreciation of that is 2 million. Then 4 million minus 3 million. The disposal gain is 1 million. So that disposal gains supposed to go to other income. So you can make a working call other income. Working number 1, other income, disposal gain, 1,000. So on the top of the page, you can say rupees 1,000. Rupees 1,000. Okay. So we are done with that. I think now we can finalize the PPE account. So building opening balance was 18,000. There was no change for building during the year. 18,000. Then the closing balance also will be 18,000. No change there. Then motor vehicle it's gonna be 19,000. Land don't have accumulated depreciation. Office equipment we are depreciation revaluing at the end of the year, so accumulated depreciation is gonna be 0. Motor vehicle 1,700 plus 4,300 minus 2,000, that is 4 million. Then the carrying value of land is going to be 15,000. Building is going to be 15,000. Motor vehicle, that's also going to be 15,000. And office equipment is going to be 5,000. And the total carrying value of PPE is going to be 50,000. 50,000. Okay. Now you can record this in here in SOSP PPE. Say note number 2, 50,000. Done. Then next, they have given the components of administration and distribution expense. What you can do is you can take this and record in your note number 1. Director 3,200. Director 3,200. You can say the full value. Director 3, 1,200,000. Then you can take advertising expense. Advertising expense 1,450,000. You can take any of the expense which are correct out of here, no issues. I prefer taking the least interest and the least depreciation, but you can take any of these. Don't take this depreciation of motor vehicle, record the correct value that you found here. You can record these depreciation values, that's totally fine. Okay, then moving on to the next adjustment. The interim dividend paid to ordinary share is shown as other distribution cost. This other distribution cost that is given here, that refers to interim dividend. Interim dividend is not a distribution cost that we record it under changes in equity statement. So remove that from distribution cost. Okay, minus, you remove that interim dividend, minus interim dividend, the value was 400. That other distribution cost 400, remove it and put it to the statement of changes in equity. Interim dividend under retained earnings minus 400. Okay. Then next one. No entry has been made for audit fee of 300,000 payable as at 31st March 2021. They have not recorded the audit fee. So audit fee is an expense. So that audit fee, right? Audit fee. Audit fee should go to administration expense. Audit fee $300. You can even record it under note number 1. Audit fee 300,000. And now make sure to record that as a payable asset. It's not paying, they have not paid it, right? So then audit fee payable 300,000. Okay. Then the next one. The company entered into a lease agreement on 31st of March 2021 at the end of the year to obtain the right of use of a plant for a period of 5 years. So a plant, somewhat a factory or a huge machinery plant like that. So according to the lease agreement, rupees 2,500,000 was paid on 31st March 2021. According to the lease agreement, 2,500 was paid on the date they got into that lease agreement, they paid 2,500,000. So that's the down payment. As the down payment, okay, that mentioned. 5 annual lease installments of 971,000 each should be paid over the lease term, and the first installment is due on 31st March 2022. So the the first installment is to be paid from next year onwards. The total interest payable over the lease term is rupees 1,355,000. So here there is a lease period of 5 years. The interest for that entire 5 years is given as 1,355,000, which includes rupees 420,000 interest for the year ending 31st March 2022. The interest for next year out of this entire interest for 5 years is 420,000. Only the down payment has been recognized as the right of use asset and no entry has been made in this regard. So now we have to find the lease liability. So note number 3, first of all, we'll make a note. Note number 3, right of use asset. Right of use asset, rupees 1,000. So down payment is 2,500,000. You're supposed to add the lease liability to this to find the cost of it. Now, how are we going to find the lease liability? In this case, you can find it like this. Lease liability equals I'll just write it here. Lease liability equals total installment minus total interest. Okay. Now we know that installment includes interest, right? Now here the installment for 1 year is 971,000. We have to pay this installment over a period of 5 years. Then the total installment you have to pay for all 5 years together is 4 million. You have to multiply that by 5. 4,855,000. I'm writing it in thousands. The interest for the 5 years. The interest for the 5 years is 1,355,000. 1,355,000. Then the lease liability. The lease liability is 3,500. The lease liability is 3,500. So the cost of this asset is 6 million minus accumulated depreciation. So anyway, we know, right, this asset is purchased at the end of the year. They got into the contract at the end of the year, therefore there won't be any depreciation for this year. Therefore, the carrying value would be 6 million. You can record it here in the SOFP. Note number 3. You can say note number 3, 6 million. Then next, you are supposed to divide this lease liability as current and non-current. 3,500,000 you have to divide as current liability and non-current liability. Current liability is next year installment minus next year's interest. So the installment for each year is 971. 971,000 is the installment. The next year's interest that's included in next year's installment is given as 420. 420. And if you remove the interest amount for next year from next year's installment, you will get the current liability portion as 551,000. And how do you find the non-current liability? The total liability amount minus the current liability, you will get the non-current liability amount. That will be 2,449,000. Now you can record this in your SOFP. Current liability in here, lease creditor, non-current liability, lease credit. Now, why didn't I draw a lease creditor account and put installment, interest and all of that? Because we got into the lease agreement at the end of the year. So we will not pay any installment for the current year. There is no any installment applicable for the current year. Nor is there any interest applicable for the current year because it's purchased at the end. So you will not have to prepare a lease creditor account. The closing liability amount, you can directly divide it as current and non-current. So don't mix up the current and non-current liability here. Be careful about that. Current liability is 551. Non-current liability 2449. It was 2449, right? Yeah. Okay. Then next. Income tax paid includes 500,000 paid for the previous year and the tax paid for the first 3 quarters of the current year. The income tax payable for the last quarter of the current year was estimated as rupees 200,000. Okay, we'll draw an income tax account. I'll draw income tax account, provision for income, balance brought forward, cash, P&L amount, balance carried down. So the opening provision for income tax opening provision is, where is it? Provision for income tax 600,000, BDS 600,000. Income tax paid amount 1,900,000. 1,900,000. The liability of the last quarter will be the closing liability amount. The last quarter's income tax payable is 200,000. So the BCD 200,000. You can balance off and find out how much is the amount relevant for the year. The relevant for the year amount 1,500. So what are you supposed to show in the working? Working number 2, you are supposed to show estimated income tax. So minus or plus under over provision. So plus or minus under over provision, you will get the income tax for the year. So how do you find estimated income tax? That is income tax paid for this year. So totally income tax paid is 1,900,000. Out of that, we have paid 500,000 for last year. Then for the first 3 quarters of this year, we have paid 1,400. 1,400 plus. Now that's for the. So I'll just tell you all how to find estimated income tax. Where can I show that? Show it here. Estimated income tax equals tax paid for quarter 1 to quarter 3 plus tax payable for quarter 4. Okay. Now the tax paid for the first 3 quarters is 1,400, right? Totally we have paid income tax of 1,900. Out of that, 500 is related to last year's payable amount. Then we have paid for this year's 3 quarters 1,400. And the tax payable for the last quarter is 200. Therefore, the estimated income tax is 1,600. So estimated income tax is 1,600. Now opening provision is 600. We have recorded a provision of yeah. So for last year we had made a provision of 600,000 and we had paid actually the actual amount we paid for last year is, that means the actual amount we had to pay for last year is 500,000, which we made the payment this year. That means we have given an extra provision of 100,000 last year. That's called over provision. Over provision is to deduct it from the estimated income tax because you have recorded extra last year, right? You have to deduct it. Over provision 100. Then you can get the income tax expense. Income tax expense for the year as 1,500. So here, into the T account also, we got that same amount. Income tax expense for the year 1,500. Okay. So you can record the payable amount here in current liability, income tax payable, or you can say provision for income tax. would be a better term, 200. And for their amount, 1,500, you can record it. You can record it here, income tax, 1,500. Okay, then that is done. Next. The financial statements of the company were authorized to issue by the directors on 31st of May 2021, and the following events took place prior to this date. Okay. A trade debtor of the company was declared bankrupt on 1st of May 2021. Okay, so that happened, he went bankrupt before the authorization date. The trade receivable balance shown in the trial balances at 31st March 2021 includes 600,000 receivable from this debtor. So this debtor was there during the year as well. The debtor was there during the year, he went bankrupt before the authorization date. Therefore, that is a adjusting event. So you have to record this as bad debt. Bad debt goes on the distribution expense, 600,000. That's not it. You have to remove it from the debtor. Trade receivable 7,400,000. You have to remove it from that. 7,400,000 minus 600. That will give you 6,800,000. Trade receivable 6,800,000. You can show it within bracket. 7,400,000 minus 600. 6,800,000. Then next, a building with a carrying amount of 5 million was fully destroyed due to a fire occurred in 15th of April, 15th of May. So these are non-adjusting events. You can record it as a note. So I'll just write here note number 4. Note number 4, you can say a building. You can just write it down. A building with a carrying amount, a building with a carrying amount of rupees 5 million was fully destroyed, due to a fire occurred on 15th April 2021. Okay, so then that is done. Same thing that I have missed. Okay. So we have recorded all the additional information. Now we can tick the trial balance amounts. Property, plant and equipment, everything is adjusted. Inventory 4,250,000 you have to record under SOSP 4,250,000. Trade receivable done. Trade payable also 4,250,000 we have to record it under current liability. Trade payable 4,250,000. And then right of use asset we adjusted. Cash and cash equivalent 500. Cash and cash equivalent 500. And stated capital, retained earnings, opening balances we can record 38,000, 12,500. 38,000, 12,500. Then sales and cost of sales. Sales 60,000. Cost of sale 38,500. And admin expense, distribution, finance, other we recorded in the expense analysis sheet. Income tax is also done. So now we can total our, start with the expense analysis sheet. You can total it. Okay. All right. Total 7,200 minus 500 minus 400 plus 600, that is 6,900,000. 6,800,000 plus 300, 7,100,000. Then 1,600 and 1,200. Okay. So now we can record this in SOPL. 6,900,000. So here our profit before tax is note number 1. Other income working number 1, working 2, working 3, working 4, working 5. Okay. Working 2, working 3, working 4, working 5. Then for this taxation, we'll make it working number 6. Keep it as working number 6. Income tax working number 6. Okay. So distribution expense 6,900,000. Administration 7,100. Other expense 1,600,000. Finance expense 1,200,000. Total expenses are 16,800,000. The other income we can record. There is only one other income apparently. The disposal gain 1,000. Now gross profit will be 60,000 minus 38,500. That is 21,500. 21,500 plus other income 1,000 minus expenses 16,800. Profit before tax will be 5,700. That revaluation from land was 5,000. I've not recorded the number. Then 5,700 profit before tax minus the income tax 1,500. Profit for the year 4,200,000. For that, if you add the revaluation surplus of land, you get the total comprehensive income as 9,200,000. Now that 9,200,000 total comprehensive income, you have to record in statement of changes in equity. So profit for the year 4,200,000 will go under retained earnings, and the revaluation surplus will go to the revaluation reserve account. Now you can total your equity. Stated capital will be 38,000, revaluation reserve 5,000, and retained earnings 16,300. 16,300 plus 5,000 plus 38,000, that is 59,300 total equity. Okay. Now stated capital 38,000, you can record in SOFP 38,000. Revaluation reserve 5,000, there was no any general reserve, and retained earnings 16,300,000. Total equity 59,300. Okay. Then we can total our current assets 4,250 plus 6,800 plus 500, that is 11,550. If you add it with your non-current assets 50,000 plus 6,000 plus 11,550, 67,550. 67,550 will be your total asset. Then equity 2,449, you can take it here, and your current assets will be 300 plus 551 plus 200 plus 4,250, that is 300, 551, 200, 4,250, that is 5,301. Okay, so if you add it with your total equity and the non-current liability, 69,300, so 38,000 plus 5,000. Okay, wait, lease creditor amount, lease liability, I missed something. 3,000, hit 3,500, total liability 3,500, sorry, 3,500 minus the current liability 551, that is 2,000,000 2,949. 2,949. 2,949. Okay. Then it will balance. 59,300 plus 5,301. 67,550. Total equity and liability. It balance. Okay. So then we have not completed the note one. You can just add a expense. With the bad debt expense, you can record. Bad debt, you can record any expense that's not an issue. 600,000. Okay. So then we are done with company account. Yeah. So moving on to the next question after this. So the second question. Mithun Education Institute was established on 1st of May 2021 to conduct lectures for professional accounting programs. So lecturers serve in this institute. Each lecturer has to conduct a minimum of 40 hours of teaching per month, and an additional payment is made for any extra teaching hours. So remuneration per lecturer. So lecturer salary includes monthly fixed payment of 100,000 for minimum teaching time. Minimum teaching time, as in they are referring to this 40 hours. Fee for any extra teaching time. If they teach 1 hour extra, they'll be paid 3,000 for each extra hour. The following additional information also provided. Due to COVID-19 pandemic, the lectures were conducted online, and each lecturer was paid a temporary internet allowance of 5,000 per month. Okay. Then, okay, these are some deductions. Employee loan. Okay, so when the teachers, the employees, they take a loan. So from the salary, they'll deduct the installment every month. So that's this. And then salary advance. If you have taken your salary early, and now they will deduct it from the salary. So those are deductions. The lecturer bearing employee number 3. Okay, this one. Also serves as the manager of this institute, and he is paid an additional monthly fixed payment of 50,000 in this respect. So that employee number 3 is a manager also, so he's getting an extra 50,000 fixed allowance. EPF contribution are 15% and 10%, employer 15, employee 10%. Employer contribution to ETF is 3%, ETF 3%. All payments except the temporary internet allowance paid for working online are considered in calculation of EPF and ETF. So they are considering all the earnings when they are calculating EPF and ETF except for the internet allowance. So you have to deduct internet allowance when you're finding the EPF ETF amount. Okay. So we have the basic salary, extra hours, the overtime, not overtime, actually, the amount paid for the extra hours taught, internet allowance, and fixed allowance for employees as the earnings of them. Then that together will give you the gross salary. Then you have deductions, the employee contribution to EPF, loan installment, and salary advance. Then you will get it's actually net salary here. Net salary. Oh no, wait. This is the total deduction. Sorry. Total, you can say total deduction. Total deduction. Okay. So then monthly fixed payment for minimum teaching hours. Now see, everyone had worked for a minimum of 40 hours, right? That's the minimum working hours. So fixed payment 100,000. So employee number 1, 2, 3. 100,000, 100,000, 100,000. Extra hours worked, each extra hour 3,000. Employee number 1 worked 50 hours. That means 10 hours extra. 10 into 3,000, 30. He worked for 40. 30 extra hours, 30 into 3, 90. Employee 3 didn't work for any extra hours, 0. Internet allowance, every lecturer gets the internet allowance of 5,000 during the COVID period. And the employee 3 gets a fixed allowance for working as a manager, 50,000. Okay, then the gross salary will be 135, 135, 195, 155. Then now EPF employee contribution and employer contribution will be calculated after deducting the internet allowance. What all the salary earnings except for internet allowance is considered when calculating EPF and ETF. So 135 minus 530. 130 into 10%, 13, 190. You should remove the internet allowance when calculating EPF. 190 into 10%, 19, and here 15. Okay. Then loan deduction. Loan deduction, employee number 1, 40, employee number 3, 60. Salary advance, employee number 2, 25. Then total deductions, 63, 44, 75. Then the net salary, gross salary minus the total deduction, you can get net salary. 135 minus 63, 72. 195 minus 44. Okay. 135 minus 63, 70. Wait, wait. 13 plus 13 plus 40 gives you 53, not 63. Okay, sorry. So 135 minus 53, that is 82. Then 195 minus 44 gives you 151. 155 minus 75 gives you 80. Then EPF and ETF also if you calculate from the net gross salary other than the internet allowance. So 15% of 130, that is 19.5. 15% of 195, that is 29.25. 15% of 150, that is 22.5. Then ETF expense, 3 divided by 100 into 130, 3.9. 3 divided by 100 into 190, 5.7. 3 divided by 100 into 150, 4.5. Now you can total all these columns. 300, 120, 15, 50, and 485, 47, 100, 25, 172, 313, and 70.5, 14.1. So then salary control account, how do you prepare? You should take the gross salary to the credit side. What you're going to say there, you're going to say salary expense account is a expense account debit, salary control credit, salary and wages, you can say salary expense account 485. It will be debited to the salary expense account, salary control account credit expense. Then you should debit all the deduction. EPF, it will go to EPF payable. EPF payable credit 47. Then loan installment in salary control debit, loan installment account credit 100. Salary advance 25. So when you total this, the remaining amount you have to pay, right? So they have not said the remaining amount, is it paid or payable? So you can just say both. Cash also fine, payable, what? It's not an issue. Or you can just say both 485 If they specifically say it is payable next month or it's paid in cash, then you should mention that particular thing. Okay, 485 minus 47 minus 100 minus 25, that is the next salary amount 313, which is payable to the employee. Okay. So then that is done. And the B part of this, yeah, so the pay sheet and the salary control account. B part of this, Samadhi PLC manufactures two types of fruit juice, mango and orange. It has a factory consisting of two production departments, namely the processing and bottling and a service department. Okay. Stores, the service department is the store. All these departments are located in the same premises. The budgeted overhead for the next year at the maximum activity level are as follows. Okay, they have given some budgeted overhead. So we can record it. Production manager salary. They have directly given the amount. You can say direct or allocation. 384 for processing department, 326 for bottling department, service department 0. The total is 710. Then storekeeper salary. That's also directly given. Storekeeper salary, direct. So that's 300 only for store. For processing and bottling, no. 300. Okay. Indirect wages. Indirect wage. My handwriting is not very clear. Yeah. Indirect wage. Indirect wage 1,200,000. No, 1,000. Yeah, 1,200,000. You have to divide it based on number of employees. Number of employees. Number of employees, the ratio would be 6:5:1. 6:5:1. So 600 for processing, 500 for bottling, and 100 for service. Then electricity charge. Electricity charge you have to divide based on the kilowatt hours. Kilowatt hours, 4:3:1. 240. Then 240, the total ratio 8. 240 divided by 8 into 4, 120, 90, and 30. Then rent. Rent expense 480. Rent expense you can divide based on the floor area. Floor area, that will be, you can divide it based on the ratio 15:5:4. That's the least you can divide it. So if you divide everything by 2, you will get, divide everything by 2000, 15:5:4. You can't divide it further. So total ratio is 24, then 480 divided by 24 into 15, 300 divided by 5, that is 100, and here 80. Okay. Then machine depreciation. Machine depreciation, that you can divide it based on the machine cost. Machine cost, 1,500 and 500, that will be 3:1. 3:1, 120. So there is no machine in store. So 120 divided by 4 into 3, 90, and here 30. So you can total it then. Total 710 plus 300 plus 1,200 plus 240 plus 480 plus 120. That is 3050. 384, 620 plus 300 plus 90, 1494. Then bottling 326 plus 500 plus 90 plus 100 plus 30, 1046. Service department 510. Okay. So then you have to reapportion it. Reapportionment. How are you going to reapportion? The total overhead of the stores are reapportioned between processing and bottling department at the ratio of 3:2. Okay, so 510 divide by 5 into 3, 306, 204. Then you can get your final total. Final total after reapportioning. The total won't change, 3050. Processing department 1494 plus 306, that will be 1,800,000. Bottling department 1046 plus 204, 1250. And service department is going to be 0 because we reapportion that. So first requirement is done. Then the second requirement is overhead absorption rate of processing and bottling department. So processing department absorbs overhead based on machine hours. Bottling department absorbs overhead based on direct labor hours. Okay. So then second one, overhead absorption rate for, first of all, let's find for processing department. Processing. Budgeted overhead divided by machine hours, right? Processing department, machine hours, yeah, machine hours. Budgeted overhead is 1,800,000. Machine hours in the processing department is 60,000 hours. How much is the OAR? That's gonna be rupees 30 per machine hour. Okay. Then overhead absorption rate of bottling department, budgeted overhead divided by labor hours, right? The bottling department absorbs overhead based on direct labor hours. Budgeted overhead is 1,250,000 and the direct labor hours is 50,000. It's going to be 1,250 divided by 50,000 rupees 25 per direct labor hour. That's the labor hour. That's the OAR. Third requirement, total cost per bottle of mango juice and orange separately. Total cost per bottle. Okay. So first of all, okay, third requirement, mango, orange. Mango and orange. So direct material, direct labor, direct material 115, direct labor 50. Those two together will give you prime cost. Prime cost is 115 plus 50, 165. Now for this, you have to add your production overhead. So firstly, we have our overhead cost centers are the processing department and bottling department. Under processing department to produce mango juice, you are using 2 hours. That means 2 machine hours. 2 hours into, for 1 hour, it's 30 per machine hour. So the overhead of the processing department that goes to 1 unit is 30 into 2 hours, 60. Bottling department is also using 2 hours. The bottling department, the overhead is rupees 25 per labor hour into 25. So overhead that of the bottling department that will go to 1 unit of mango juice will be 50. Now you can total that 115 plus. Okay. Here this is machine hours and labor hours. Yeah? Okay, processing department, we are absorbing overhead based on the machine hours. So 2 hours into 30. Bottling department is using labor hours. So labor hours, you are using 3 hours. Okay, so 3 into 25 is 75. 75. Okay. So then cost per bottle of mango juice is 115 plus 6. Okay, that's 165 plus 60 plus 70 rupees, 300 per bottle of mango juice. Fourth, then orange juice, direct material, direct labor, prime cost. Then for that you have to add the production overhead. So in production overhead you have your processing department and the bottling department. Then you can get the cost per order. So direct material cost is 70. Direct labor cost is 60. Prime cost would be 130. Processing department is using machine hours, that's 3 hours into per hour 30. Bottling department is using labor hours, that is 5 hours into 25 per bottle. So 3 into 30 is 90, 5 into 25 is 125. So then 130 plus 90 plus 125, that is 300 and rupees 345 per bottle. So third requirement is also done. Fourth one, selling price per bottle of mango juice is 20% profit margin on selling price is maintained. Okay. Now, cost per bottle is orange mango juice, right? Yeah, they're asking for mango. Cost per bottle is 300. They are going to maintain a profit of 20% on selling price. So selling price. If they're calculating profit on selling price will be 100%. Profit will be 20% of selling price. The remaining 80% will be the cost of that bottle. So cost of the bottle, if it's 80%, and you're supposed to add a profit of 20% to it, 300 divided by 80 multiplied by 20, that is 75. Then you can get the selling price rupees 375. Okay, so we are done with the second question as well. So then the third question, Kalyani Enterprises commenced on 1st of April 2021 as a sole proprietorship for trading stock. The following transactions occurred in this business during the month of April. So we are supposed to record this transaction number 1 to 12 in the accounting equation. Okay, so the first one, Kalyani, the owner of the business, invested 500,000 in cash plus 500 cash and opened a bank current account by depositing this amount. Okay. She also provided a photocopy machine, that's equipment, plus 750 as a part of initial capital. All the cash transactions of the entity are carried out through the bank account. Okay. So then how much is her total investment? 750 plus 500, that is equity plus 1250 capital. Transaction number 1. Transaction number 2. So transaction number 2, purchase stationery costing 200,000 on credit. Inventory plus 200, trade payable plus 200. Third one, return stationery costing 40,000 supply due to poor quality. Inventory minus 40, trade payable minus 40. Fourth one, sold stationery costing 60,000 for 100,000 on credit. So inventory minus 60, you're selling on credit, so trade receivable plus 100. And then there is a profit of 40, equity plus 40. Fifth one, a customer returns stationery sold for 10,000. Okay, customers, now we know that. Okay, only the ones who purchase credit can return the goods. So then a customer returns stationery sold for 10,000. So trade receivable minus 10,000. You sold it for 10. The cost of the stationery is 6. So you're getting your stock worth 6,000 back. The profit of this is 4,000. Now when they're returning, the profit is reversing. You have to reverse that profit minus 4. 6,1. Settle the amount due to stationery supplier rupees 160 subject to a 5% discount. We settled 160,000 to the supplier. So trade payable minus 160. The settled amount is the amount of which the trade payable is reducing by. Okay, we are settling 160. Out of that settled amount, we are getting 5% as discount. 5 divided by 100 into 160. Discount is 8,000. So equity plus 8,000 discount received. It's the income. Then 160 minus 8, you're supposed to pay in cash the remaining 152. Cash minus 152. Seventh one, donated stationery costing 3,000 to preschool. Donation is an expense, inventory minus 3, equity minus 3, donation expense. Eighth one, received a check amounting to rupees 9,000 from a debtor after allowing a discount of 1,000. Here they are saying received a check amounting to 9,000. The received amount is 9,000. You're getting in cash 9,000. So cash, now check and bank, all the transactions related to cash and bank are done in the bank current account only. Okay, so then cash plus 9,000. Apart from that, you are giving a discount of 1,000, equity minus 1. Okay, then totally the debtor is settling 10,000 by paying 9,000 cash and the remaining 1,000 is given as a discount. Ninth one, electricity bill payable for the month of April. For this month, we have to pay. So we haven't paid, so it's payable electricity 7. So it's the electricity expense of this month, right? Equity minus 7. If it is paid, cash will be minus, but here we didn't pay. It will be a payable accrued expense plus 7. Then the 10th one, paid rupees 5,000 as the monthly maintenance expense of the photocopy machine. So maintenance expense, cash minus 5, equity minus 5, so expense. 11th one, obtained 5,000 photocopies and sold them on cash during the month. Okay. You obtained 5,000 photocopies. The selling price and stationery cost per copy was 7 and 4. Now, for one photocopy, you're selling it at 7 rupees, maybe per paper. Stationery cost, maybe you can take the paper charge, A4 paper charge, and the ink charge, the average cost for one page. The ink charge, totally stationery cost is 4 rupees for one photocopy. So the income you're getting is 5,000 papers, photocopies into 7 rupees each, the selling price. 35,000, you're getting it in cash. So cash plus 35. The stationery cost for one printout, you can say photocopy is 4 rupees. 4 rupee into 5,000 copies is 20. So stationery inventory minus 20. So the profit you're getting here is 15, equity plus 15. So then you can do the 12th one. The depreciation of the photocopy machine for the month of April is 15, equipment minus 15, equity minus 15. Then you can get the total finally. So this is going to be 735, 200 minus 100 plus 6 minus 3 minus 20, that is 83, 80, 387. It's gonna be 0, 7, equity 1, 2, 50 plus 40 minus 4 plus 8 minus 3 minus 1 minus 7 minus 5 plus 15 minus 15, 1, 2, 7, 8. Okay, requirement 1 is done. Then requirement number 2, revise balance of the cash account and the bank reconciliation requirement number 3. So number 2, adjusted cash control. rupees 1000. Requirement number 3, bank reconciliation is 1000. Okay, so you have to put the opening balance. The closing balance of the cash column is take as the opening balance of adjusted cash control 387. So here they have given the following additional information were obtained from the bank statement received on 5th of April, 5th of May 2021. This information has not been considered in calculating the cash balance of the business as at 30th of April 2021. The check of 5,000 issued for the maintenance expense of the photocopy machine has not been presented to the bank. So that check of 5,000 we gave for maintenance expense not presented to the by the bank to the bank. That's a timing difference. It's a problem with the bank. Okay, that the person whom we gave that check to hasn't presented it, but we paid it right. So we have recorded. Bank has not recorded unpresented check. You add unpresented check 5,000. You have to add that. Okay. Then bank charge for the month of 1,000. The bank charge, okay, we have to record in adjusted cash control credit side. Bank charge 1,000. The monthly school fee of the owner's daughter 5,000 has been paid per standing order. It's a drawing. Standing order. Standing order, you can say drawings within bracket. 5,000. A customer has deposited 20,000 directly into the bank. Direct remittance, direct remittance 20,000. So you can total the cash control 387 plus 20, that is 407. 407 minus 6, 401, balance carried down. So suppose to take the adjusted cash control balance to the bank reconciliation. And then you can get the balance as per bank statement 406. 406. Okay, so that is done. Then moving on, income statement for the month ended. Income statement. Okay, so then the first transaction was a purchase of equipment that doesn't affect the income statement. Then purchases, we don't have to record. Now, I'm not going to do the cost of sale as opening stock plus purchase minus closing stock. Instead, we can directly get the cost of sale from the relevant sale transaction. So third one, return stationery. We don't have to record. Fourth one, sold stationery costing 60,000 for 100,000 on credit. Okay, so there the sale value is 100,000. The cost of that sale is 60,000. Okay. A customer returns stationery sold for 10,000. So sales will be minus 10. The cost of the stationery is 6,000. Cost of sale minus 6. Settle the amount due to a stationery supplier, rupees 160,000, subject to a 5% discount. So that's the discount received. Sixth one, discount received 8,000. Discount received 8,000. Then donated stationery costing 3,000. Donation is an expense. Donation 3,000. Then received a check amounting to 9,000 from a debtor after allowing discount of 1,000. Discount allowed. It's an expense. Discount allowed 1,000. Electricity bill payable for the month of April 7. Electricity expense. Electricity expense 7,000. Paid rupees 5,000 as monthly maintenance expense of photocopy machine. Maintenance expense 5,000. Then obtained 5,000 copies, sold them. Okay, the sale here, 11th one, we sold for 35,000, the photocopies, income 35, the cost of stationery incurred for that 20, that will go to cost of sale. Then depreciation is an expense. Depreciation 15,000. Now you have to also record the bank related transaction, the ones that we figured out from the bank statement. Check of 5,000 issued for maintenance expense, we have recorded that. That's just unpresented. It's a bank issue. Uh, Bank charge for the month issue, that's the expense. Bank charge 1,000. Monthly school fees of owner's daughter. That's a drawing. You don't record here. Customer has deposit 20,000. That's a receipt from a customer. That's not an income or expense. Total sales is then 100 minus 10 plus 35, 125. Cost of sales 60 minus 6 plus 20, 74. So then gross profit will be 125 minus 74, 51. For that you have to add the other income of 8. 51 plus 8, 59. Then you have to deduct the total expense. 8 plus 3 plus 1 plus 7 plus 5 plus 15 plus 1. That is 40. Then 59 minus 40, net profit is 19,000. Have a missed something. 61 plus 8 is 59. 3175. 3 plus 1 plus 7 plus 5 plus, sorry, the expenses are 32. 32. Okay, so 59 minus 32, the net profit will be 27. Net profit is 27. Okay, that was a very easy question actually, the third one. Net profit 27. Okay. So the fourth question now, starting off with investment appraisal part. Gamage PLC is considering to acquire a high-performing machine to produce electronic items to the local market. The estimated price of the machine is rupees 6,500,000. Further, the transportation cost and installation cost of this machine have been estimated as 50,000 and 200,000 respectively. Okay, now these are the initial investments, right? So you can record it in cash outflows saying that machine cost, I can say machine purchase price. The machine purchase price is 6,500,000. Those are initial outflows. Further, the transportation cost and installation cost. Okay, transportation, and also you got installation. Transportation cost and installation cost. The transportation cost is 50,000. Installation is 200. 50,000 and 200,000. The useful life of the machine is estimated as 6 years. Okay, then this project will be, this investment will be working for, the machine will be working for 6 years. So I have to, okay, I need to draw another column. Here. And all right, here. So then that's done. Yeah, yeah. Okay. 6 years. The working capital requirement at the beginning. So if 550,000. Working capital, it will be initial outflow. Working capital 550,000. Okay, and it can be recovered in the last year. Then it will be inflow in the last year. Working capital will be inflow in the last year. That's called terminal cash flow 550. The residual value of the machine at the end of the year is estimated at 750. You can the estimated amount at which you can sell this machine at the end of the useful life of 6 years is 750. So residual value 750. The expected annual profit after tax and the discounting factor at 12% required rate of return of the project are as follows. So they have given the profit after tax. Then how do you have to get the cash flows, right? Annual cash flow. Annual net cash flow you can find through the profit. How is that? Annual cash flow equals the operating cash flow. Annual cash flow equals profit after tax plus depreciation. Now you assume depreciation is the only non-cash transaction here. When you add back the depreciation to profit after tax, it will convert back to your cash flows. So how much is the depreciation here? That is, now out of this, what will be a part of the machine cost? The machine purchase price, transportation, installation, all of these are cost of the machine, part of the cost of the machine. So according to LK 16, 6,500 plus 50 plus 200, that is 6,750 minus the residual value is 750 divided by useful life 6 years, the annual depreciation is 1,000. So for each year's annual profit after tax, if you add this depreciation, you can get the cash flow. 550 plus 1,000 is sorry, not year 0, year 1, 1,150, 1,800, 1,950, 2,250, 2,050, 1,750. So year 0 there is no inflow. Year 1 inflow 1,150, 1,800, 1,950, 2,250, 2,050, and 550 plus 750 plus 1,750, that is 3,050. And the initial outflow 6,500 plus 50 plus 200 plus 550, that is 7,300 outflow means minus. The net cash flow 7,300 year 0 negative, year 1 1,150. Here there are no outflows since they have given, we found the annual net cash flow itself. So 1,800, 1,950, 2,250, 2,050, and 3,050. Now you have to multiply the cash flow with the discounting factor to find how much is the present value. So for year 0, the discounting factor is always 1.0, no matter whatever the percentage is. 1.0, just 1, no problem. Year 1, 0.89, 0.79, 0.71, 0.64, 0.57, and 0.51. And if you multiply this with the discounting factor, you get the present value as the present value of year 0 will still be 7,300. 1,150 multiplied by 0.89 will give you 1,023.5. 1,800 into 0.79 will give you 1,422. 1,950 into 0.71 will give you 1,384.5. 1,950 into 0.71, 1,384.5, 10,150 into 0.89, It's 550, then 1000 plus 550, 1550. 1550. Then here gonna be 1550 into 0.89. 13. Let me write that. Not today, sorry. 1379.5. Then 2250 into 0.64. 1440. 2050 into 0.57. 1168.5. And 3050 into 0.51. 1555.5. If you add all the positives, 1555.5 plus 1168.5 plus 1440 plus 1384.5 plus 1422 plus 1379.5, and then you deduct the negative 7300, you will get your net present value as 1050. Okay, so then you have completed requirement number 1, 2, and 3. Then the fourth requirement will be the recommendation. Since the NPV is positive, you can recommend to invest. Since the since the project generates a positive NPV, it is recommended to invest. Recommended to invest. Okay, so that is the fourth one's A part. So then the B part. Samanala PLC Limited, located in Nuvareli district, is involved in trading vegetables. Okay. This company is registered for VAT. The following balances as at 1st of January 2021 were extracted from the ledger. So that is cash balance, debtor, trade creditor, VAT, control account, fine. Cash was received on 20th Jan to set. Okay, wait. What are the requirements? You have to prepare the cash receipt journal, cash payment journal, cash account, and debtor control account. So cash receipt journal, cash payment journal, cash account, data control, and VAT account, and journal entries to rectify errors and statement of to correct profit or loss. Okay. So then we'll record the opening balances. Cash, we can record BBF 100. Then we have debtor 150, VAT 20. Debtor BBF 150, VAT BBF 20. So then the first transaction. Cash was received on 20th of January 2021 to settle the above trade debtor balance. The company settled above trade creditor and VAT balance on 31st of Jan 2021. Okay, on 20th of January, to settle the above trade debtor balance. This balance, the debtor had paid. Okay, so then that will be a receipt. Under cash receipt journal, you can say debtor 150, debtor 150, and amount also 150. And the company settled above trade creditor and VAT balance. Okay. In cash payment journal, you can say creditor 250, 250. Now we are paying the VAT to the IRD, Inland Revenue Department. You have to put on the other column. The VAT column is only for VAT on purchase. That is 20. Okay. Then the company sells vegetables on credit to wholesale traders in the Manning market with a credit period of 30 days. The company sells vegetables on credit. If the full amount is settled within 15 days, a 10% discount is allowed on the sale value without the VAT. Okay, the information extracted from the sales journal for the month ending 31st Jan 2021. The credit sale amount is 1,800. The VAT in that is 144. Now you have to put this to the debtors account. So debtors account, you are going to say sales and VAT. Sale amount is 1,800. The 8% VAT included in that 144. 1,800, 144. Then next what is happening? Both Kasun and Amila settled the full amount within 15 days period. However, Prabhat paid only 600,000. Okay. Both Kasun and Amila settled the full amount within the 15-day period. What is the full amount Kasun should pay? 648. Amila should pay 432. Okay. So now, Prabhat has paid only 600,000. If you pay the full amount within 15 days only, you get a 10% discount in on the sale value without VAT. So on the sale value, you are getting a 10% discount. So Kasun will get a 60,000 discount. Amila will get a 40,000 discount. You have to give the discount on the sale value excluding VAT. Then how much will they pay in cash? 648 minus 60, that is 588. 432 minus 40, that is 392. And Prabhat will pay 800 Prabhat will pay only 600, right? Prabhat is paying 600. Okay, so you have to record it in the cash receipt journal. Kasun, Amila, Prabhat. Kasun, Amila, Prabhat. Kasun will be paying in cash 588. Amount 588, debtor 588. And he will be getting a discount of 60. Discount allowed 60. Amila will be paying 392 after discount. He will be getting a discount of 40. And Prabhat is paying 600 and he doesn't have any discount. Okay. Then the next one. The cash sale. This company also has a vegetable shop in Nuvaraliya where all the sales are done to wholesale traders on cash. The cash sale for the month was 324,000 including VAT. And this will be 108% because including VAT, then 324 divided by 108 into 100. The sale value is 300. The VAT value in that case 24. Okay, the VAT is 8% calculated on the sale value, which is 100%. But I said this is 108%. So you're getting this entire amount in cash. You can say sales 324. Out of that, the sale value is 300. The VAT amount is 24. Okay. Then next, purchasers and trade creditors. The company purchases vegetable from a small-scale farmer on cash, and it purchased from Nadun Traders, a large-scale vegetable supplier, on credit. Okay. During the month, credit purchased from Nadun Traders amount 756, including 8% VAT. Okay. Now we purchased on credit 756,000, including 8% VAT. So now we don't have to record that anywhere because we don't have a credit account, but we have to record the VAT amount in the VAT control account. So how much will be the VAT on this credit purchase? 7. So purchase plus VAT will give you the total amount including VAT. So purchase will be 100% because VAT is calculated on the purchase value. VAT is 8%, then the total will be 108%. They have given the amount including VAT as 756. So 756 divided by 108 into 8, that is 56. Then the purchase value will be 700. So this purchase VAT amount you should record under the VAT control account debit side. Purchase VAT is an input. You can say credit. That's from the credit purchase VAT 56. 56. Okay. So then that is done. Rupees 600 was paid to settle 605 payable to Nadun. So cash payment journal, Nadun, 600. You are getting a discount of 5. You are settling 605 by paying 600 means the remaining 5,000 is discount and it goes to credit. The next one. The cash purchase made from small scale farmer were 500,000. VAT is not applicable for this purchase. Then there is no VAT. You can just say purchases 500. Then expense and other income. Operating expense paid during the month is 198,000. Operating expense 198. It goes to expense column 198. Then VAT is not the company obtained 54,000 from wholesale trader to transport vegetable to Manning market. They charged the 54,000 from the wholesale trader. So that is the other income. Transport income. Transport income 54,000. It will go to other. Okay. Then next. VAT is not applicable for both operating expense and other income. Okay. Then draft profit. The draft profit for the month ending 31st January 2021 was 856. Following errors were revealed, and you have to correct the profit next. So draft profit will put to statement of profit or loss correction. Draft means the wrong one before correction. Draft profit is given as 856. Okay. We'll total the prime entry books and come to error correction. Discount allowed 100. Cash receipt value 150 plus 588 plus 392 plus 600 plus 324. 2054. 300. 150 plus 588 plus 392 plus 600. 1730. 54. 24. Cash payment journal. 5. Here you are supposed to say posted to ledger. Posted to general ledger. Posted to ledger. Okay. 5. 250 plus 600 plus 500 plus 198. 1,005. This fact amount I have put in. 250 plus 20 plus 600 plus 500 plus 198. 1568. Here also I have not recorded the 54. 54 plus 54. 21 08. Here 2108. So then purchases 500, creditor 850, expense 198, other 2. Then cash control account, you can record the sale amount. Okay, firstly, discount allowed, you can record under debtors. Discount allowed 100. Sales amount cash debit, sales 300. Receipt from debtor, cash account debit, debtors account credit 1730. Debtors account credit cash 1730. Other is the transport. You can say transport income 54. And the VAT on sales, VAT control 24. Then VAT control account credit cash 24. Then cash payment journal. Discount received will be credited to discount received account, credited debit. Purchases credit 500. Creditor credit 850. Expenses operating expense 198. VAT paid to Inland Revenue Department 20. Then VAT account debit cash for IRD 20. Now you can balance off this 100 plus 300 plus 1730 plus 54 plus 24, that is 2208. 2208 minus 20 plus 19 is 198. 198 minus 850 minus 500. The cash balance will be 640. Balance carried down 640. Then debtors account 150 plus 1800 plus 144, 2094. 2094. Balance carried down 1000 minus 1830, 264. Then the VAT control account 56 plus 20, 86. 86 minus 44. 42 will be the BC and D. No, wait. Okay, I haven't recorded the debtors VAT. Yeah. So now here you can see the VAT charged by debtor. So that time said you are supposed to put it there. The VAT charged from debtor on sales 144. Debtors account will be debit. Debtors account debit. VAT account credit. Debtor 144. Okay, total this 20 plus 24 plus 144, 188. 188 minus 56 minus 20, 112. 112. Okay, VAT control account balance 112. Then the other part, the draft profit for the month 856, we put that in the draft income statement, and we have to make the general journal entries to rectify the errors and record it in the statement of profit or loss correction. The balance of the discount received and discount allowed account has been omitted in the computation of profit. They have not recorded it. So we'll record it first in the here will general journal. Balance of discount received and discount allowed accounts only. So how are you going to record that? Then discount received, we are going to say P&L, profit or loss account, profit or loss account, discount received should be credited. It's a income, no? Discount received amount is 5,000. Discount received debit, sorry, credit 5,000. It's income. So they are saying only the discount received account is the problem. So discount received is debited to creditor. But they are not saying there is any problem in creditor because they are specifically saying the discount received and discount allowed account only has been omitted. So it's recorded in the creditor's account. Then where will you debit it? To the suspense account. Suspense account debit 5. Sorry, here it should be credit 5. Profit or loss account, discount received, credit 5. Suspense account debit 5,000. Profit or loss debit 5,000. Rectifying error of not recording discount received. Okay. And then discount allowed that is 100. Discount allowed is 100. So again, discount allowed account is also omitted. So discount allowed is an expense. Discount allowed. So you're supposed to write in the profit or loss. No, they have not recorded in the P&L. So you have to correct it in the P&L. So profit or loss account debit 100. You can say discount allowed. Suspense account will be credited by 100. Rectifying the error of not recording discount allowed. Not recording discount allowed. Then the next one, the operating expense paid has been correctly recorded in cash payment journal, but it has been posted to operating expense account as 98,000. Here operating expense 198,000. They have undercasted it. So then you can say profit or loss again, that's expense. Profit or loss account, operating expense, debit 100 and suspense account, credit 100. Rectifying the error of undercasting operating expense account. You can say like that. Now you have to correct these errors in the statement of profit or loss. Whatever the income or expense that are credited, you add. Whatever income and expense that are debited, you deduct. So then here, discount received credit. You have to add it. Plus discount received 5,000 minus profit or loss discount allowed debit. You have to deduct. Discount allowed deduct 100 and operating expense debit. Operating expense 100. Then you will get the corrected net profit as corrected net profit 856 plus 5 minus 200, 661,000. Done with the fourth question as well. It's a bit long but easy to do. Okay. So the fifth question, partnership. Lal, Ravi, and Priyal carried out a partnership. The terms of the partnership agreement were as follows. So Lal, Ravi, and Priyal share profit and loss in the ratio of 5 to 3 to 2. Every partner is entitled to a monthly salary of 50,000. And they are supposed to get an annual interest of 10% on the opening balance of the year, and all adjustments with respect to goodwill should be made through the partner's capital account. Okay. First, we will start with the additional. We can put the opening balance of capital and current account. That's not an issue. So, capital account BBF, BBF. Everyone had a credit balance, right? Yep. Everyone had a credit. Oh, no. PL has a debit current account balance. Okay. Okay. So BBF 4,000, 3,000, 2,000, 4,000, 3,000, 2,000. Then current account BBF. Lal and Ravi will be 190 credit balance. Priyal has a debit balance of 60. Okay, 60. Then additional income one. Salary received and goods drawn by the partner during the year are as follows. Salary received, that means the amount they have got in cash. The salary earned will be credited, the amount paid to them will be debited. So partner's current account debit, cash credit. So salary and goods drawn. Whatever partner takes out of the business will be debit. Salary drawing. So salary, that is 500, 400 and 200 they are taking, and drawing 80 and 20. PL is not taking anything. Alright. Salary paid to partners have been recorded in operating expense. Good drawings have not been recorded. The cost of inventory has been ascertained based on physical count. Okay, first of all, the salary that is paid to partner is recorded under operating expense. Salaries for partners are not operating expense, right? So in the income statement, you can say operating expense 3,500 minus salary is 500 plus 400 plus 300, 1,200. So 1,200 you have to deduct. And then next what has happened? The goods drawings has not been recorded. The cost of the inventory has been certain based on physical stock count. So they have counted the closing stock based on physical stock count. That means you have to deduct the goods drawing from cost of sales because you're going physically and counting. And the drawings goods won't be there. The owner has taken, the partners have taken it out. And you will assume everything else is sold. But no, you didn't sell everything else other than what is there in the warehouse. The partners have taken some. That's 100. So you have to remove that under cost of sale. The cost of sale that is mentioned here is 4,000. So from 4,000, you have to remove 100. Okay. Then next, the loan indicated in the trial balance was provided by Lal on 1st of April 2020. Interest on this loan is neither paid nor accounted for. So the loan provided by Lal, that is 2,000. Okay. Have they mentioned any interest amount for loan? No. Then you should follow section 24. Provide loans for existing partners 5%. 5% of 2000 is 100. So Lal, interest on loan, Lal 100. Okay. Then next one, Ravi had paid 20,000 to a trade creditor of the partnership out of his person. Okay. Now this Lal's interest you have to credit to his current account also, right? We have to pay it to Lal. Interest on loan, Lal 100. Okay. Ravi had paid 20,000 to a trade creditor of the partnership out of his personal money, but this has not been recorded. So if a partner pays some expense or a payment of the business from their own money, it will increase their current account balance. Okay. Creditor, you paid a creditor. How much is that? 20,000. Ravi. Here it's 90. Okay. Then Ravi retired from the partnership on 31st March. The goodwill of the business is estimated as 1,500,000 on this date. Lal and Pial agreed to continue the partnership sharing profit or loss at a ratio of 3:2 respectively. Okay. So before he retires, we have to transfer his current account balance next. So we have to find the profit, give him his profit and all of that, and then only do the retirement adjustment. So then PPE investment operating expense done, cash, is there anything that we have to record in income statement, capital account recorded, current account recorded, okay, now, so we can finalize our sales. Sales is 12,000. Cost of sale 3,900. Then gross profit will be 12,000 minus 3,900, 8,100. Operating expenses will be 2,300. 2,400. Then the net profit will be 8,100 minus 2,400, that is 5,700. Now interest on capital 10% on opening balance. So 10%, 400, 300, 200, 400, 300, 200. Partner's salary. Partner's salary will be every partner is entitled to a monthly salary of 50. Then annually 600,000. Salary 600, 600, and 600. Okay. So here it's 900, 1,800. So 5,700 minus 900 minus 1,800, that will give you 3,000. The profit sharing ratio between Lal, Piyal, and Ravi is 5 is to 3 is to 2. So 1,500. So you can write here 5 is to 3 is to 2. 1,500, 900, and 600. So then that's 3,000. We have appropriated our profit. So you can put this interest and capital, partner salary and profit share to the partner's current account. So interest on capital, partner's salary, and profit share. So interest on capital, that will be 400, 300, 200. Salary of each partner was 600,000 per annum. And the profit share was 1,500, 1,500, 900, and 600. So now you can balance this off. 100 plus 100 plus 400 plus 600 plus 1,500, that is 2,700. 90 plus 20 plus 300 plus 600 plus 900, that is 1,910. PL 200 plus 1200, 1400. Now who is the one retiring? The retiring partner is Ravi. So then the Ravi's amount, you have to transfer to the capital account because he's retiring. When retiring, the current account balance should be transferred to the capital account. So Ravi, 1900, okay, 2700, 1910, and 1400. So for Ravi, 1910 minus 400 minus 20, 1490 should be transferred to the capital account. For the other two partners, you can take BCD, 2700 minus 580, 2120, then 1400 minus 260, 1140, 1400 minus salary paid to PL is 300, 300. Salary is 300. Then here it will be 1040. Okay. So you have to transfer the Ravi's balance to capital account, saying current account. You took the balance from current account. So from current account, you are going to record 1490. 1490. Now you can do the goodwill adjustment. Goodwill. So goodwill adjustment. Ravi retired. Okay, the goodwill of the business is estimated as 1,500,000. So old ratio was 5 is to 3 is to 2, right? So that 1500 you can divide 5 is to 3 is to 2. 1500 divided by 5 is to 3 is to 2. 750, 450, 300. The values are disappearing. So goodwill. So here I took the balance from the current account earlier. The value got disappeared. Current account I took 1490. Okay. The goodwill old ratio and the goodwill new ratio you have to debit. Goodwill. How much was that? The new ratio 3 is to 2. Now Ravi is retiring. Then Lal and Priya. 1500 divided by 5 into 3, 900, and here 600. So what's happening? It was agreed to settle the amount payable to Ravi as follows. To transfer the ownership of investment. We are giving the investment to Ravi. There's investment of 1200 we are giving to Ravi. Okay. Investment to Ravi 1200. Again. So 900 and 600. Okay. And investment to provide an office equipment at its carrying amount of 300. Office equipment 300. And the balance amount as a loan. Okay. Now you can balance off and find the loan amount of Ravi. 4,750. 3,000 plus 1,490 plus 450, that is 4,940. 2,300, 4,750, 4,940, 2,300. Ravi's loan amount 4,940 minus 1,500, 3,440. The other two fellows carried down balance 3,850 and 1,700. Okay, and the partner's capital account is done. Current account also was done, but the values had disappeared. Okay, so you can say the third requirement is asking for the loan amount. Third requirement, Ravi's loan rupees 3,440,000. Ravi's loan 3,440,000. Okay, so we are done with the partnership question. A few more to go. So the next part of the question is a cash flow question where you have to just prepare the cash flow from operating activity only from both direct as well as indirect method. Okay, so you can say now whose business? Sarang, Sarang PLC cash flow from operating activity, the direct method rupees 1,000. Saranga PLC cash flow from operating activity indirect method rupees 1,000. Okay, so let's get started. Here we have additional information. All sales and purchases are made on credit. So in direct method, now if the sales and purchases are made on credit, you need to find out, you won't have cash sale and cash purchase, then you have to find out how much is paid to our creditor and how much is received from our debtor. So how you can find that? You will have to prepare a debtor's account and a creditor's account. Debtor, creditor. So you can put the opening balances. Debtor's opening balance, debtor BBF. Debtor BBF. So opening balances here, be careful of the dates. Don't mix it up. 6,000 and 5,200. Where did that come from? Something glitching here. 6,000 and BCD 5,200. And now all the sales are made on credit, right? So this sales 25,000 you can take here. Sales 25,000. Then you can balance and find how much is the cash paid to cash received from debtor. So 31,000 minus 5,200, that is 25,800. So you can say cash received from debtor 25,800. Now for creditor, you will have to find the cash paid to creditor. So BBF, purchase, BCD, cash. So we'll put the balances, that is opening balance of trade payable is opening balance of trade payable is 4,250, closing balance 3,500. 4,250 and 3,500. 4,250 3,500. Now we'll have to find the purchase through the cost of sales. So opening stock plus purchases minus closing stock will give you your cost of sale. So in this question, the cost of sale is 15,000. Opening stock and closing stock are 1,800 and 2,400. 1,800 and 2,400. Now you can reverse and find your purchases. 15,000 plus 2,400 minus 1,800. Purchases will be 15,600. Purchases 15,600. Now you can balance and find how much is the cash paid to creditor. 15,600 plus 4,250, that is 19,850. 19,850 minus 3,500, that is 16,350. Damage anything. Opening balances. Thousand 800, 2,400. Cost of sale 15,000. 15,000 plus 2,400 minus 1,800 is 15,600. 16,350. Okay. So 16,350, 16,350. So that is cash paid to creditor. Cash paid to creditor 16,350. Okay. Then next, the finance expense entirely consists of interest expense and it relates to operating activity. Okay. The operating expense include depreciation of 1,800. So finance expense, interest receivable is there, accrued interest expenses there. So this is interest income, that is the investing activity. Accrued interest is there. Operating expense, finance expense. Okay. All right. So here there is finance expense 1,500. So you can prepare a T account to figure out how much is the interest paid during there. Interest, opening balance, opening accrued interest. So accrued interest payable, opening balance 650 in the question. Closing balance is 400. And the P&L, the finance expense includes the interest expense for their 1,500. 1,500. Then you can balance off and find out how much is the interest paid during there. 650 plus 1,500 will give you 2,150. 2,150 minus 400 will give you cash 1,750. So somewhere around here, after you write everything, you can find and deduct it. Interest paid 1,750. Here also you can say interest paid 1,750. You can put it within bracket. Okay. Now that operating expense include 1,800 depreciation. Operating expense 4,500. Is there any okay, that is prepaid operating expense. So prepare a T account. Operating expense Next, prepaid. So opening prepaid operating expenses 200, closing operating expenses 500, prepaid operating expense. Then the operating expense given in the income statement for the year 4,500. Now we want to find the cash paid amount next. So we remove the depreciation. Then 4,500 minus depreciation given in the question is 1,800 in an additional information number 3. Then we put here P&L 2,700. Then when you balance off, you can find out how much is the operating expense paid in cash. So this is 4,500 minus the depreciation 1,800. 2,700 plus 500, that is 3,200,000. 3,200 minus 200, that is 3,000. 3,000. Okay. So you can say operating expense paid 3,000. Okay. Then next, other income consists of the following. Gain on disposal of motor vehicle, that you can do for the indirect method. You have to add it, right? It's the gain on disposal is already added to the selling price of that particular PP, which is an investing activity. So you should remove it from adjustment. Disposal gain, you have to deduct. It's an income. To remove, you have to deduct. Disposal gain, you have to remove 800 under adjustment. Interest receivable 5-year fixed deposit 400. Interest receivable on the 5-year fixed deposit 400. Okay, that means nothing is received, so you won't have to remove interest receivable. Okay, so that other income includes the interest receivable of 400, and you have to remove that. It's a non-cash transaction. And even if it's received, you have to remove because that will be an investing activity. Interest receivable 400. Okay. Then profit before tax 5,200. You have to remove the interest expense because the paid amount we are going to record here, right? Interest expense given in the income statement, you have to remove 1,500. That's the expense. To remove expense, you have to add. And then you can deduct the actual amount paid, that's 1,750. Then income tax, let's find income tax payable. We need to find, right, the paid amount. So draw a T account. I'll draw that here. Income tax. BBF, BCD, PNL, cash. Opening accrued income tax. Opening accrued income tax is 450, closing 300. 450, 300. Then the for the year amount, income tax expense 1,000. So 1,450 minus 300, that is 1,150. So income tax paid, income tax paid 1,150. 1,150. Okay. Then next, under adjustments, you have to add the depreciation. I haven't added that. Depreciation is a non-cash transaction. Depreciation, you have to remove it. So you add 1,800. Then you have to do the working capital adjustment. You have trade receivable. Trade receivable is decreasing. So decrease in trade receivable, decrease in debtor is decreasing by 800. So if a current asset is decreasing, you have to add it under cash flow. I have left out inventory. Inventory is increasing by 600. Increase in inventory. Inventory is a current asset. Current asset has a negative relationship with cash flow, so minus 600. Inventory increasing now, you have to deduct. Then current prepaid operating expense increasing by 300. Increase in prepaid operating expense, you have to deduct 300. And accrued interest expense, you don't do it because income tax and interest expense, you don't adjust under working capital because the actual amount paid, you record it here. Then interest receivable, you will not adjust because it's connected to investing activity. I'm finding for trade payable. Trade payable is a current liability that is decreasing. If a trade current liability decreases, you have to deduct. It has a positive relationship. So creditor is decreasing by 750, right? 750 you have to deduct. Now you can find out your cash flow. So here you can find 25,800 minus 16,350 minus 3,000, that is 6,450, that is cash flows generated from operating activity. From that, if you deduct the interest paid and the income tax paid, 4,450 minus 1,750 minus 3,550, net cash flows generated from operating activity. Then the next one is the indirect method. 5,200 minus 800 minus 400 plus 1,500 plus 1,800, that will give you 7,300 plus 800 minus 600 minus 300. Cash flow generated from operating activity, we have separated. Minus creditor 750, that disappears. Minus 750, that is 6,450. 6,450 minus 1,750 minus 1,150, 3,550. So that is cash flow from operating activity based on the indirect method. Okay. So yeah, operating activity indirect and indirect method, you are putting the same value. If that so, you have done it correctly. Okay. So then that is done. Moving on to the sixth question. So the Development Society of a school decided to conduct a six-a-side cricket tournament to raise funds for the society. The expected revenue and cost of the tournament are as follows. So that is entrance fee charge, food and beverage cost, charge for umpire, cost of trophies and certificate, sport equipment, charge for music band, sanitizer pack per team. Okay, so first of all, variable cost. Variable cost per team, you have per team cost, food and beverage cost, per team cost, food and beverage. Food and beverage cost is 4,000. Food and beverage cost 4,000. And cost of sanitization pack per team. So whatever the cost per team, those are variable costs. Sanitization 1,000. So variable cost per team, variable cost per team is 5,000. Okay. Then total fixed cost of the tournament. The total fixed cost of the tournament, you can take this entrance fee is the income from one team. Charges for umpire. No matter how much teams come, the charges for umpire will be fixed. Umpire. Charges for umpire 15,000. Then you have cost of trophies and certificate. Trophy and certificate 50,000. Trophies and certificate 50,000. Okay. Then next, sport equipment hiring charge. Equipment hiring charge. Sport equipment hiring charge 25,000. And charges for musical band. Musical band 8,000. Then food and beverage for the organizing committee. That's a fixed cost. Food for organizing committee 12,000. Okay, those are fixed costs. I didn't see this. The Old Boys Association of the school has agreed to provide a sponsorship of 60,000 if a minimum of 35 teams participate in the tournament. Okay, that is if 35 teams are participating. Okay. Then total fixed cost will be total fixed cost will be 15 plus 15 plus 50 plus 25 plus 8 plus 12 110,000. So say rupees 110,000. Third requirement, contribution per team. Selling price minus variable cost will give the contribution per team. The selling price here will be the entrance fee charge for a team, 10,000. That's the selling price of the ticket. For per team, you have to spend a variable cost of 5,000. Therefore, the contribution per team will be 5,000 rupees. Okay. Then next, the number of teams required to cover the total cost of the tournament. That means for you to come to a level where you're earning neither a loss nor a profit, a zero profit level. That's the break even. How much units you need to sell to earn a sufficient contribution for you to cover your total fixed cost and then earn a profit or loss of zero. There you have to find a break even point. So fourth one, BEP equals total fixed cost divided by contribution per unit. Total fixed cost 110,000 divided by contribution per unit is 5,000. 110,000 divided by 5,000, that's going to be 22 teams. At least 22 teams should join for you to come to a level where you're covering your total cost. If less than 22 teams join, you're going to incur a loss. If more than 22 teams join, you're going to get a profit. Then the fifth one, the number of teams required to obtain a surplus of 40. So here you can use this equation, expected units or expected teams in this case equals total fixed cost, write the full term, plus surplus or profit. Okay, in a profit earning business, you're supposed to say profit here, divide by contribution per unit. So here what you can do, you can either use it to find the expected units or the surplus. Here they are saying find the number of teams you need to earn a profit of 40,000. Sometimes they'll say if this much people, if this much teams participate, how much is the surplus you will get? For both of that purpose, you can use this equation. So here they have given the profit, the surplus they are expecting to earn. So then total fixed cost 110,000, expecting to earn a profit of 40,000, surplus 40,000, contribution per unit will be 5,000. Then how much team should participate for you to get a surplus of 40,000? That is 110,000 plus 40,000, that is 150,000 divided by 5. At least 30 teams should join. At least 30 teams. So 30 teams should join for you to get a surplus of 40,000. Okay. Then sixth one. The surplus expected from the tournament if 35 teams participate. Okay. Total surplus expected from the tournament if 35 teams participate. Then you can prepare income statement in this case, because if 35 teams participate, you are getting a sponsorship of 60,000. So sales will be 35 teams into per team the charge is 10,000. 350,000 minus variable cost per team. So 35 teams into variable cost 5,000. That will be 175,000. Then the total contribution will be 175,000. Now there is a donation sponsorship, right? You can add the sponsorship here, like a kind of other income. Sponsorship 60,000. From that you can deduct the total fixed cost. Total fixed cost 110,000. You will get your surplus amount 175 minus plus 60 minus 110. Your surplus amount will be 125,000 if 35 participants are 35 teams are participating, and you're getting a sponsorship of 60,000 because of that. Okay, so we are done with the marginal costing part. Then the ratios. So ratios, first one, net profit ratio. Net profit ratio equals to net profit ratio equals net profit divided by sales multiplied by 100. Now here you need to find a net profit. Here you have gross profit. We'll do a working. Gross profit is given as 30,000. From the gross profit, you have to deduct operating expense. 12,000. Then you have to deduct interest expense. Now this will be this gross profit minus operating expense is called profit before interest and tax, PBIT. Okay, just you can have it there, not required. 30 minus 12, 18,000. So you can just directly deduct the interest also after that. Interest 6,000. And from that, if you deduct the interest, you will get now profit before tax. 18,000 minus 6,000, that is 12,000. From this, if you deduct tax, the income tax expense 3,000, you will get the net profit or profit for the year. Profit for the year or profit after tax. or net profit, either one. 9,000. So net profit is 9,000 divided by how much will be your sales? Sales is, see here, the gross profit ratio of the company for the year ending 31st March 2021 was 25%. Okay. So gross profit ratio equals gross profit divided by sales into 100. So gross profit ratio is 25%. Gross profit is given as 30,000. And how much will be sales? Sales will be 30,000 divided by 25 into 100. That will be 120,000. So this as workings. Sales 120,000 into 100. And your net profit ratio will be 7.5%. That's the answer. Then the second one, debt collection ratio. On average, so how many times do you convert your debtors into cash, right? So debt collection, debt collection ratio. Oh, wait, the second one is quick ratio. I will write it here. So quick asset ratio equals current asset is to current liability. So what are the current assets you have? Inventory, debtor, prepaid expense, cash, long-term loan, non-current liability is 29,000. And the totals if you get 29,000 and here 21,500 plus 17,500 plus 7,500 plus 11,500, that is 58,000. So if you get it in simple, current liability, if you take it as 1, current asset is how many times of current liability? 58,000 divided by 29,000, that is 2 times. So the current ratio is 2:1. You have 2 times of the current asset compared to the current liability. And the third one is the debt collection period, not ratio, debt collection period. So debt collection period equals average debtor divided by credit sale into number of days in the year. Have they given an assumption? Assume the number of working days per year is 360. Average data will be opening data plus closing data divided by 100. The following information has been extracted from, okay. Okay, or the debtors. Closing data balance 22,500. Opening data balance 22,500. Closing data balance 17,500. Now, how do you find average data? Opening data 22,500 plus closing data 17,500 divided by 2. That is 20,000. Divide by credit sales. All the sales are carried on credit basis. Now we found our sales here as 120,000 divided by 120,000 into 360. Debtors collection period will be 60 days. That means it normally takes you around, on average, 60 days to get the cash back from your debtor. Then the fourth one, inventory turnover ratio. How many times do you convert your inventory into sale during the year? Inventory turnover ratio equals cost of sale divided by average inventory. Average inventory. Cost of sale is how much? Here, your sale is 120,000. Gross profit is 30,000. And the difference between sale and gross profit is your cost of sale. You can show it as a working 90,000 divided by average inventory. Closing inventory 21,500. Opening inventory is given as 18,500. Add those two and divide by 2. Average inventory will be 20,000. Then 90,000 divided by 20,000. The inventory turnover ratio will be 4.5 times. That means on average during the year, you will convert your inventory into sale around 4.5 times. Then the fifth one, debt to equity ratio. So debt to equity ratio, that will be debt to equity ratio equals debt capital is to equity capital. You can show it this way also. So how much is the equity capital? The stated ordinary share capital and reserves as at 31st March 2020 is 81,000. This is the opening balance, right? This year is 2021. They are given the balance of 2020. This is the opening equity. Opening equity is given as 81,000. How do you find closing equity? For that, you have to add the profit. The profit for the year is the only item that has contributed to the change in equity. The net profit for the year, 9,000, you have to add. Then the total equity, closing equity will be 90,000. Okay, equity 90,000. Your debt capital is the long-term loan, 54,000. Then if your equity is 1 rupee, how much of debt capital you have? 54,000 divided by 90,000. It is 0.6 times. 0.6 times. Your debt capital is 0.6 times of your equity capital. Or you can show it as a percentage as well. Debt capital over equity capital into 100. 54,000 divided by 90,000 into 100, that is 60%. That is also fine. Okay, so ratios are done. Then moving on to the last question, the subscription and income statement. Okay. BRS Sport Club had 165 members as at 1st of January 2020. The annual subscription per member is 6,000. Okay. The information relating to membership subscription for the year ending 31st March 2020 is as follows. Last year. During the current year, okay, this is the year, no? Okay, this year. The year is ending on 31st December 2020. During the current year, 25 members were admitted and they paid annual subscription for 2 years at once. Okay. The annual subscription was received. The annual subscription was received from 15 members as at 1st of January 2020. Receivable. So annual subscription was receivable as at opening date. So opening receivable they are talking about. BBS 15 into 6,000. 18,000. That will be 90. The membership of 10 of these members were cancelled as they failed to pay the arrears in subscription. Okay. So subscription written off. The membership of 10 of these members was cancelled as they failed to pay the arrears in subscription for the previous year and the current year by 31st of December. So we are considering them as members during the year and writing off the membership of last year and this year. So totally for 2 years into 2 years. So annual subscription is 6,000. We are writing off for 10 members into 2 years, the last years and this year. We are considering them as members during the year because they attend the subscription is written off at the last date. Okay. Then the balance 5 members paid their subscription in arrears and the current year subscription. Okay. And also here, during the current year, 25 members were admitted and they paid annual subscription for 2 years at once. Then that one extra year, that will be advance, right? 25 into 6, closing advance, BCD 150. Okay. 12 members has not paid the current year subscription. That will be the closing arrears. 12 into 6, 72. 72. Now the subscription amount for the year, income and expenditure statement. How many members were there for the year? 165. BSR Sports Club had 165 members as at the opening date. During the current year, 25 members were admitted. So plus 25, 190 members into 6,000, 1,140. If you total it, 1,380, you can deduct these values and find the cash received amount. 1,380 minus 72 minus 120, 1,188. So now in the income statement, you can show under income, subscription income, 1140. And under expenses, you can show subscription written off 120. The following information has been extracted from the receipt and payment account of the sports club. Subscription received we found. Donation received 1,200. Can we consider it as income? We'll see. The policy of the sports club is to recognize the donation as income over the period of 5 years starting from the year of receipt. So we have to recognize this donation over 5 years. Then for this year, how much can we recognize? 1,200 divided by 5, 240 will be a donation income. Donation income. Interest received from income received from sport event. Income received from sport event and purchase of office equipment. Income received from sport event, you can record as income. There is only payable or accrued amounts. Yeah. So then sport event income 790. Okay. Sport ground. Purchase of sport equipment. Okay, now here we have to find the depreciation of sport equipment. For that, prepare sport equipment account. Sport equipment. Opening balance of sport equipment is 1,500. This is the carrying amount, net book value. Then depreciation also recorded here. Closing balance 1,600. Then we are purchasing sport equipment on cash 400. Now you can balance off and find the depreciation. 1,900 minus 1,600. Depreciation will be 300. So you can say sport equipment depreciation 300. And next, office expense payable. Okay, subscription received in advance none. Okay, allowance of coaches you can record as expense. Allowance of coaches, that no any accrued amounts in 1,150. Now for the as for the office expense payable, now you have to record the office expense payable account and find how much is paid. Office expense payable. Opening payable balance is 100. Closing payable balance 70. For their amount, cash amount will be debit. For their amount, credit. For their amount, office expense for our okay. The following information has been extracted. Okay. Received in cash 550. Sorry, office expense paid in cash 550. And when you balance off, you can find the for their amount 550 plus 70, that is 620. 620 minus 100. 520 is the for the year amount. So office expense for the year 520. Now you can deduct all this and find the surplus. 1,140 plus 240 plus 790. Your total income is 2,170 minus 120 minus 300 minus 150 minus 520. Your surplus will be 80,000. So now we are done with the entire paper. All right.